Well, hello and welcome to this afternoon's webinar, Inside AAII Growth Investing, a Mid-Year Snapshot and Future Prospects, led by Wayne Thorp, Lead Editor and Analyst for AAII Growth Investing. Thank you so much for joining us. We are happy to have you all here. My name is Jenna Brashear and I'll be your host for today. And then a few things to go over before we begin. I want to remind all of our webinar viewers that AAII is a nonprofit educational group and is not a financial advisor, and thus is not able to give personal advice. Every investor is different. That's why our goal with each broadcast and article is to educate you on how to make better financial decisions. And a handout of the presentation is available under the handout section of your GoToWebinar control panel, which is located on the right-hand side of your screen. And additionally, a copy of the slides used during today's presentation will be sent to all of you who attended via email. And if you have questions for our speaker during the presentation, please submit them using the questions section of your GoToWebinar control panel, which is also located on the right side of your screen. And once our presentation concludes, John, our moderator for today, will select a few questions for Wayne to answer. And any questions that are not selected for the broadcast today will be reviewed and addressed afterwards. And if you experience any issues with the audio or the video of the webinar, please consult the instructions on how to change your device's settings or consult the GoToWebinar support at gotowebinar.com. And just a friendly reminder that this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, along with links to this presentation's handouts and any resources that we discussed today. And the PDF and the link to the recording will also be available at aaii.com/webinars. And for new viewers, we do like to give a little background about our organization. The American Association of Individual Investors is an independent, nonprofit corporation formed in 1978 for the purpose of assisting individuals in becoming effective managers of their own assets through programs of education, information, and research. And for those who are not Growth subscribers yet, let me share a few tidbits about our newest service. AAII Growth Investing is focused on teaching individual investors on how to become successful long-term growth investors, as well as providing members with exclusive access to our 20 stock model portfolio of secular growth investments. And with that, I'd like to hand over the presentation to John.
Oh, thank you very much, Jenna. It's a great introduction, a lot of good information provided by you there. And my name is John Bykowski. I'm president of the American Association of Individual Investors, and I'm pleased to be your moderator today. So my job will be to stump, and as well as your job will be to stump our main presenter here, Wayne Thorp. Wayne Thorp has a great history here at the association. He heads up our research here, and he has been in charge of developing our stock screens, developing a number of our model portfolios. And the last few years has really been his passion has been how to crack the code of developing a sustainable growth technique that can be used to find stocks that have not only a good track record historically, but are poised to do well in the future as well on a growth level. And so with that, please, I'd like to welcome Wayne Thorp to our presentation today.
Thank you very much, John, and thank you, Jenna, for hosting as well. And welcome everyone. Welcome everyone to today's webinar. And for the next hour or so, I'm going to be walking you through the genesis of the growth investing approach and what led us to what we have today. And along the way, I'm going to give you an overview of the selection criteria I use for the real money growth investing portfolio, and how you as a growth investing subscriber can create and manage your own portfolio of sustainable growth stocks. I'll also be reviewing the portfolio's mid-year and since inception performance, as well as offering my personal views on what could be affecting the portfolio for the rest of the year. As Jenna mentioned, be sure to submit your questions via the dashboard, and John may be asking them along as I go along, or be holding them to the end. I will certainly make sure to reserve some time at the end. But also, you can reach out to me at any time by email at Wayne, W-A-Y-N-E, at AAII.com. And with that, let's get started. So what initially led me to try to develop a growth-oriented stock selection approach was more the who and not what. And the who are the AAI members such as yourselves. At least on an annually basis, we survey our members. And one of the questions we ask year in and year out is, what is the preferred investment style of our members? And historically, nearly half of our members have stated that they prefer growth when they look to an investment strategy. So based on this information, we found that our members are very much interested in growth investing. But when we looked at our AAII model portfolios, specifically the AAII model shadow stock portfolio, the stock superstars report, dividend investing, and VMQ stocks, we found that none of these portfolios really had a pure growth component to them. So this led me to start looking for a solution to fill our members' needs. But one of the problems I've faced is that many growth strategies historically have tended to underperform over the long term. So the question I asked was, are most growth investment strategies doing it wrong? And if so, could I produce a growth investment approach that attempts to do it right? So personally, I'm not a market timer. I know I've met many members over the years who swear by market timing and claim to have done very well by it. But I don't consider myself a market timer. I don't think I'm smart enough to do that. So I don't try to gauge market tops or bottoms, and I don't try to ascertain when certain investment factors or styles will fall into or out of favor. However, I do believe that across all market and economic conditions, there are simultaneous investment opportunities across disparate approaches, such as growth and value. The key is to have a reasoned strategy that fits your investment profile and that you believe in. And additionally, that you have the discipline to follow, even if it underperforms the market or your benchmark for months or quarters at a time. I set out to create a strategy that seeks out companies with characteristics that should generate sustainable long-term growth, which limits the possibility of the company disappointing the market, which usually leads to significant price declines, especially among growth stocks. These price declines, which tend to normalize valuations back to market or historical levels, are often referred to as reversion to the mean. And this phenomenon is what I believe is why most growth strategies tend to underperform. The testing that I used to generate the growth investing approach led me to companies with consistent, sustainable top-line growth with prolonged histories of profitability and cash flow generation. I also have a long-term investment horizon for this portfolio, at least 3 years, that further offsets the impact of high current valuations. So I started with a popular premise for growth strategies that seek out the highest growth companies. And what I did for this particular slide here is I took the stock universe and divided them into quintiles, or 20% bands, based on their 5-year average annual sales growth. I then rebalanced these portfolios on an annual basis. And between 1998 and the end of 2022, May of 2022, the stocks that ranked in the top 20%, or those companies with the highest annualized sales growth, performed worse than those with the weakest sales growth. So let me just reiterate that. The stocks that have the highest growth underperform those with the weakest growth. Interestingly, the data also showed that companies in the middle 60% of the stock universe, based on their 5-year sales growth, performed significantly better based on that 5-year sales growth. And this corresponds with the investment philosophy of John Neff, who personally is one of my favorite superstar investors. When Neff was managing the Vanguard Magellan Fund, he and his team looked for companies generating reasonable but sustainable levels of growth. And the reason being that Neff felt that these companies could maintain this growth longer and were less apt to disappoint and see their prices punished. This is key because of the expectations that are priced into high valuation stocks. Companies growing the fastest cannot sustain this growth over long periods of time. And as this growth slows, the market tempers its expectations, and these high valuations adjust quickly and significantly, typically to the downside. This is the reversion to the mean that I referenced previously. But if you invest in companies that can generate solid growth year in and year out without much change, they are less likely to disappoint and see their stock prices punished. And this is what this chart highlights. The results of my long-term sales growth testing led me to reevaluate AAII's growth grade, which is part of the A+ investor service. As it was initially formulated, the original growth grade rewarded the highest grades to companies with the highest growth rates. So to overcome this high growth underperformance that my backtesting seemed to indicate, I created a composite that placed greater weight on growth in that sweet spot, or that middle 60% of the stock universe based on 5-year sales growth. I also looked at factors many growth-oriented mutual funds and ETFs use to select stocks, and found additional themes beyond long-term growth, such as consistency of growth and profitability. I then tested companies based on their year-over-year sales growth and their ability to generate positive cash from operations on an annual basis. And in both cases, companies that grow revenues yearly and generate positive cash flows year after year outperform those that don't. So based on all of this information and the historical analysis that I discovered, this led me to revise the A+ growth grade, placing greater value on companies exhibiting consistent, sustainable growth and those generating positive cash flows year in and year out. The result was a new growth grade that generated better performance across each higher grade, as this chart shows here. And so based on this, I then made the growth grade one of the primary elements of the growth investing approach. And while I was happy with the results that I found for the revised growth grade and the fact that I was in effect able to build a better mousetrap, I didn't feel that I still had enough to build a complete strategy around. So I was curious to see if there was a way to evaluate the quality of a company's growth and identify those characteristics that support persistent growth. Following AAII's belief in evidence-based investing, I looked for ways to mitigate the risk of investing in so-called glamour stocks. And these are stocks that investors believe will rise in price more rapidly than the market, but usually trade at sky-high valuations and may not have the fundamentals to support long-term growth. This led me to Partha Monraham's G-score. Mohan Ram is a professor in the accounting department at the University of Toronto's Rotman School of Management. In 2004, he published a paper that extends the analysis done by Josef Piotrowski, whose F-score applies fundamental analysis to filter value or low book-to-market stocks into winners and losers. Mohan Ram developed a G-score, which is an 8-factor model using financial statement analysis to assess the quality of a company's growth. Mohan Ram focused on glamour or high price to book stocks using 3 types of signals. The first, growth signals based on profitability. Second, stability or variability signals. And lastly, signals related to accounting conservatism. A point is awarded for each of the 8 fundamental tests that the company passes. For example, a company's return on assets exceeds the industry median return on assets. Mohan Ram's research and backtesting showed that high G-score stocks outperformed low G-score stocks. And to support this, AAII tested its own variation of the G-score, which was a 7-factor model due to data availability, and also found that higher G-scores generate better returns, as the chart in slide 13 indicates. The growth investing approach looks for stocks at the intersection of high growth grades and high G-scores. But one other element I integrated into the growth investing approach is quality, specifically AAII's quality grade, which is useful in weeding out potential duds. Our testing indicates that you're more apt to boost performance by avoiding companies with low quality grades than choosing companies with high quality grades. So for the growth investing approach, we overlay AAII's quality grade on high growth grade and high G-scored stocks. Just like all AAII model portfolios, The growth investing approach is not a black box. I created explicit quantitative rules that we make available to all subscribers for selecting stocks for the growth investing portfolio. And in order for a stock to be included in the growth investing portfolio, it must satisfy all of the criteria you see here on slide 17. Specifically, the G-score has to be at least 7. The growth grade has to be an A, or the growth score of 81 or higher. It must have a quality grade of A or B, the score of 61 or higher. Positive year-over-year sales growth for the latest quarter. Positive trailing cash from operations, as well as minimum market cap and liquidity requirements, up-to-date SEC filings, as well as not be OTC stocks, REITs, or Chinese or Russian firms. So these are the only criteria I look at when I am selecting stocks for the growth investing portfolio. Now, not wanting to give away the farm for this presentation, because I know that there are prospects as well as existing subscribers here. I'm not showing you the names of the companies that are currently in the growth investing portfolio. But what you see here is the list of ideas that we also provide for growth investing subscribers. And this ideas list consists of stocks that are eligible to be included in the growth investing portfolio, but currently aren't. But this pool of candidates has to satisfy all of the criteria that I just showed you. So again, these are stocks that I would draw upon when it comes time for me to replace any stocks that might satisfy the explicit quantitative sell rules that I have in place. The stocks uncovered by the AAII growth investing approach are more profitable than their peers, generate growth that they're likely to sustain, not simply the strongest, generate sales and earnings that they're likely that are more stable than their peers, as well as invest more in their businesses than their peers in terms of research and development, capital expenditures, and advertising. These companies also have a quality grade that is higher than 80% of the universe of US listed companies. Growth investing provides you with a real money portfolio of 20 stocks, as well as an ideas list of an additional 25 or so ideas. However, you can analyze individual stocks using the growth investing framework with the growth analyzer tool that is exclusive to growth investing. And this is useful because inevitably, you already own stocks. You might your own portfolio of stocks, not those that are specifically drawn upon from growth investing. And you also probably have, a watch list or something to that effect. And using this growth analyzer, you can look at these stocks that might not necessarily be in the growth investing portfolio and see how they fit within the framework of the growth investing approach. And here, for example, I've pulled up a growth analyzer page for Tesla, and this data as of Friday's close. And we see here that the company has a G score of 4, which indicates average growth potential, but it does have a growth grade of 82, which is very strong and leads to a growth grade of A. And you see below this that you have the 8 tests that go into generating the G score. And a green check mark indicates that the company has passed that particular test, and a red X means it has failed it. And for each of these, you can click on, for example, return on assets, cash flow, ROA, etc. And you'll actually be able to see what the underlying data is for the company at that point in time, and how it stacks up against probably either the sector in the industry median that test is based upon. Now, earlier I mentioned that one risk with growth stocks is the market's high expectations and the rich valuations that these expectations create. And while the goal of growth investing is to identify quality, sustainable growth companies, the stocks in the portfolio do tend to trade at above average valuations. And you can see here, this is the portfolio. Again, I've grayed out the names of the portfolio, But as of Friday's close, you can see that these are the value scores as well as the growth scores for all 20 stocks that are currently in the portfolio. And you can see that overwhelmingly, looks like 1, 2, 3, 4, 5 of the 15, I'm sorry, 15 of the 20 stocks currently in the growth investing portfolio rank in the highest 20% of the stock universe in terms of valuation. And you would expect that, obviously, if you are turned off by high valuation stocks, then this portfolio probably wouldn't be for you. But high valuation and growth stocks kind of go hand to hand, so it's not surprising to see that. But one thing that's important to keep in mind that's when you're investing in high valuation stocks, having a long-term investment horizon is very helpful. And the reason being is the data that you see here on this particular chart. And this is based on research from BCG and Morgan Stanley. And between 1990 and 2009, when they were looking at S&P 500 companies, they found that the longer your holding period, the less impactful price multiples, such as PE ratio, price to book, etc., are on stock performance. In fact, the research also revealed that the longer you hold a stock, the more important revenue growth and profitability are when it comes to performance. So just to explain this chart here, so you see moving left to right, you have a 1-year holding period, a 3-year holding period, 5 years, and 10 years. And then you have these different colored bars indicating a specific factor and its impact on stock performance over that holding period. So for a 1-year holding period, we see that 46% of a stock's performance is driven by its multiple, and only 12% is free cash flow, 13% margin, and 29% revenue growth. But as we move to the right in a longer holding period, we see that the impact that multiples have on price performance drops significantly, to the point where if you have a 10-year holding period, the research done by BCG and Morgan Stanley shows that valuation only accounts for 5% of price performance over a 10-year holding period, whereas 74% is driven by revenue growth. Now, coincidentally, one of the key factors and key elements of the growth investing approach is consistent and sustainable top-line growth. And actually, I discovered this after I've been working on the growth investing strategy. So I found that this is a nice confirmation that looking at solid and sustainable top-line growth is a good long-term strategy when selecting stocks. Now, far too often you come across a stock selection strategy that hypes when to buy, but often will leave you guessing as to when to sell.
Hey, Wayne, before you get into the sell part,
yes, sir.
You've had quite a few questions on, I guess, sort of the buy process and some of the considerations that one would take a look at when buying a security for the model portfolio. And so, like, let's say there's, first of all, a number of questions come up with the word currently qualifies. And in terms of what does that mean for a subscriber if someone comes in now? Should they, is not being currently qualified, is that probationary? Because I think you talk about being probationary, I think in the previous slide. And, what are the, there are stocks that seem to have a high growth grade or a G score, but aren't necessarily currently qualified. Can you elaborate a little bit on what currently qualified truly means and how a subscriber would use that?
Yeah, so we can back up here. So in order, so yes, so is it on this? I don't want to scroll around too much. I don't think I have it. But yes, if you go to the current portfolio at the Growth Investing website, you'll see that there is a column that indicates currently qualifies. And in order for a stock to currently qualify, it has to satisfy all of the criteria that I'm showing here on slide 17. So it has to have a G score of 7 above, a growth grade of A quality grade of B or better, positive year-over-year sales growth for the last quarter, etc. Now, inevitably, over time, things change. Companies will, most of this data is tied to quarterly results. So these grades aren't going to move too rapidly. But inevitably, when a company files its latest 10Q report with the SEC and new data becomes available, some of these underlying elements will change. And so, the G-score might fall to 6, or the growth grade might fall to B, or the quality grade might fall to C. Now, just because that happens doesn't mean that these are going to be sold. And I'll show you in just a minute what the explicit sell rules for this. All it means when a company no longer qualifies is that they don't satisfy all of the criteria required for a stock to be added to the growth investing portfolio. And over time, things are going to change. And the key is when you've created a set of selection criteria, is that you often want to flip those criteria on their head when it comes to sell criteria. And what you ultimately want to do is allow for sufficient deterioration in those elements that led you to buy it in the first place, in order to then decide when it's time to sell. So just because the G-score has gone from 7 to 6, I'm not going to rush out and sell, nor if the growth grade goes from A to B. I'm going to want to see that G-score deteriorate to, I think it's 2 or lower. I'm showing that in just a moment. The growth grade fall to D or worse, etc. So currently qualifies just means that it satisfies all of the elements. But then there also, if you go to the website, you'll see that we also have a column that basically identifies, any potential, I guess, probationary conditions that might be happening. For example, I think one of our stocks right now, its 5-year sales growth rate is nearing the bottom 20% of the stock universe. And so there is a warning on our website indicating that its long-term sales growth rate is deteriorating and may eventually lead to that being deleted. So when you're looking to build your portfolio, if it's in the portfolio, it's considered, I guess, a quote unquote buy. We don't have, holds or anything like that. But if you're looking to sort of limit yourself, especially if you're not looking to buy all 20 stocks in the portfolio, you probably want to limit yourself then to the stocks that currently qualify, and or avoid any stocks that might have any of those probationary comments on the website.
So any stock in the portfolio that is marked as not qualifying, subscribers can still hold them. In fact, you're still holding them.
Absolutely.
And a company could have a G-score of 7 or 8, but it might not be qualifying because it could, for example, might not have positive year-over-year sales growth, or it might not have positive trailing cash from operations. So it could be some other factor beyond the specific growth score or the overall growth grade that could lead to currently qualifying.
Absolutely. I mean, Tesla was a great example from the, Tesla has a growth grade of A, which is one of the requirements, but it has a G-score of 4. So it wouldn't qualify based on that. So correct.
Thank you. And then do you have, and this, if you want to cover this later, feel free to go ahead and do so. But I've got a couple of questions asking about portfolio turnover. I know that you've been operating this portfolio only for 6 months now. I don't think you've had any sells, and most of your stuff is geared more towards longer term quarterly financials and analysis like that. Do you have any sense if this would be a high turnover or low turnover portfolio?
So we did do a paper trading based on the criteria, both the selection and deletion criteria, and the turnover was very, very low. This is off the top of my head, but I believe it was no more than higher than 20% turnover. Yeah, because these grades do move very slowly, and so very rarely, it would be. Yeah, I think the turnover was roughly 20%, and it would be, I think it was primarily deterioration in the growth grade. Sorry, we got some weather coming in. Yes. And also we have, and again, I'll be talking a little bit later, but we did have, I think maybe one or two instances where we sold based on underperformance over a 3-year time window.
So
But yeah,
with a
this is a
20%
relatively low.
portfolio, yeah, turnover is almost, that assumes of almost a 5-year holding period on average. On average.
Correct.
Okay, thank you. And then I guess, and one more question, I guess, on the buy side. What role, if anything, do dividends play when it comes to selecting stocks for the growth investing portfolio?
Any dividends that are paid are incidental. Dividend-paying stocks tend to be more value-oriented. I think we have 4 or 5 stocks in the portfolio that do pay dividends, and actually, I think of that a little bit later. But yeah, dividends are not a selection criteria for this portfolio, and any dividends paid would be strictly incidental.
And do you have any tiebreaker? Let's say you've got 8 great candidates that match most of the buy criteria or all the buy criteria. How would you go ahead and pick one over the other?
My initial tiebreaker is the G-score. So I would then be looking at the stocks with the highest G-score, and then after that, I would then rank it based on the growth scores. Then take the highest.
I know you're running low on time, and I want to keep you out. So, but the question about quality grade, I guess for that one, it would be better just to, you can include anybody who's watching the webinar now or sign up for the webinar will get a link to the replay tomorrow. But also, we could include a link perhaps to further information about what the quality grade is or how it's computed. Would that be
absolutely? Yeah, I've written an article on the quality grade, as well as then we also have articles that more in depth with a deeper explanation of the G-score and the growth grade.
Great. I'll let you continue on. Are you getting into the sell side stuff? I'll be monitoring the board for questions, and then we'll be taking questions that later on as they come up. So I'll continue on, Wayne. Thank you.
Thank you, John. So as I was saying, so far too often you can come across a stock selection strategy that hypes when to buy, but will leave you guessing when it comes to when to sell. But that's not the case with growth investing. Growth investing is a full portfolio system, guiding you through the selection, portfolio management, and deletion process. And so, as I was saying earlier, is when I was looking to develop the sell criteria for this portfolio, basically what I did is I looked at the elements that a stock had to satisfy in order to be considered for the portfolio, and then try to determine at what point has things weakened enough that the stock really no longer exhibits the overall characteristics of a sustainable growth stock. And so the criteria that I settled on, and using backtesting, paper trading, and whatnot, is the G-score falls to 2 or lower from 7 or higher in order to be added to the portfolio. The growth grade falls to D or lower, so the score is below 41, where initially it has to be 81 or higher. The quality grade falls to F, so they score below 621. Negative year-over-year sales growth for 4 consecutive quarters. Negative trailing 12-month cash from operations. And then after being held for 3 years, the stock is underperforming the benchmark, which is the iShares Core S&P 500 ETF, the ticker symbol IVV. So these are the explicit rules-based deletion criteria that I follow. And it's very useful. It's very reassuring, especially when the market is sort of going all over the place, to say, I have a long-term approach. So what the portfolio does over a few weeks or a few months or even a few quarters really doesn't matter to me. I'm monitoring the rules-based deletion criteria that I have, and then over an extended period of time, in this case over 3 years, if a stock is underperforming, at which point you're probably like, okay, my overall investment thesis probably didn't work out, and that point I can say, okay, it is time to move on if it hasn't outperformed over the last 3 years. But we have, again, explicit rules-based deletion criteria for the growth investing approach. Now, I'm sure a lot of you are asking, is growth investing right for me? And that is a very personal, individual choice. And that depends on your investment approach, your investment profile, and whether you have a need or a desire for growth stocks in your overall portfolio. But even if you consider yourself a value investor who looks for stock bargains, trading for pennies on the dollar relative to earnings, sales, or book value, chances are there's still room for growth stocks in your portfolio. The question is whether it's for example, value or growth sort of the core element of your portfolio, and then the opposite sort of more your satellite holdings or allocation in your overall portfolio. And ultimately, when you are investing, investing across styles, growth versus value is one way you can diversify beyond just sort of the more traditional, and diversifying across sectors or industries. And again, I've said it before and I'll say it again, investment styles fall into and out of favor. And I can't say with certainty whether growth will outperform value this year, next year. But I do feel that while past performance doesn't guarantee future results, I do have confidence in the long-term common sense factors that we use in the growth investing approach. Well, beyond growth investing, AAII does have portfolios for all investors that encompass various investment styles. We have our model shadow stock portfolio, which is, I believe probably one of the longest continuously run factor portfolios in existence. It was created back in 1992 based on the FAMA French research that at the time showed that microcap value stocks significantly outperform all other segments of stocks over the long term. We have the Stock Superstars report, which relies on unique strategies of 4 guru investors. Dividend investing, which seeks out attractively valued stocks of companies with a track record of raising their dividends. And lastly, VMQ stocks, which is a factor-based approach that looks for stocks with attractive evaluations, as well as strong relative price momentum and high quality. Now, each of these portfolios follows strategies with little or no overlap in terms of style. So investing across them could boost the diversification benefits of your overall stock portfolio. So before I go into the mid-year review, John, do you have any other questions?
No, a couple of questions on the sell side, and I guess just an over. You were talking about model portfolios there, and a member was asking whether or not there's any costs associated with the growth investing product.
Yes. Yeah. No, it is a premium product, and we have actually the last slide will have a special price for attendees today. But yes, this is a product that is separate in addition to AAII membership.
And when it comes to the sell rules, does it have to meet all of those sell rules? Any one of those sell rules? Anything that's weighted along that line?
I get this question, and I always remember to myself, you should need to better explain that, and I always forget. It has to only, so we can go back. So slide 25 shows if a stock satisfies any one of these criteria. It does not, it's any one, not all. So it's, G-score falls to 2, it's removed. The quality grade falls to F, it's removed. So, I mean, a company could have a G-score of 8, a growth grade of A, but if its quality grade falls to F, it would be removed.
So how often do you recommend checking the portfolio against the sell rules?
Personally, if you're a subscriber to Growth Investing, you'll see that I've fallen into a cadence of doing a month-end review of the portfolio. Realistically, most of these grades and elements aren't changing more than on a quarterly basis. So I would say monthly is probably the most frequent you would need to, and realistically, quarterly attention to a company's quarterly reporting schedule.
Wayne, we just lost your video. Are you still there?
I'm still here.
Okay. I'm not seeing your video at the moment, so I thought
Oh,
I'd double check.
the little light's on, but who knows?
Okay, you're back now, at least from my screen. You're probably going to be getting into performance. When you do, just if you can make note of how many stocks are in the portfolio and things like that. So a couple
Oh, sure.
questions are coming up along that line. Are there any ESG considerations in any of this in your process?
No, there are no ESG considerations.
So no ESG, nothing macro oriented. You really it's kind of a bottom up approach. You're not looking at a top down level. You're looking really at the bottom up for the companies that particular qualify. But
Yeah,
again,
I
if
mean,
someone wants to go ahead and like people are asking about valuations as well. I mean, obviously, if someone wants to overlay their own methodology when it comes to either valuation or own sector beliefs, that's something that you could do as a subscriber. But you yourself aren't doing that.
That is correct. And as I show, actually, I don't know if I'm going to highlight that, but I have a slide a little bit later that shows that this is a highly concentrated portfolio that we let the data take us where it may. That if a company meets the selection criteria, and then using the various tiebreakers that I follow, we buy those, we add those particular stocks to the portfolio, and that's multiple things. It's a portfolio by and large of high valuation stocks, which is not surprising given a growth oriented approach. But then also it's going to be highly concentrated in those sectors and industries that have been performing strongly in the near term.
And so valuation plays no role for you. And I guess the member was asking, that was a concern, is that some of these valuations might have seemed more reasonable at the beginning of the year, but they're probably even richer now, but that doesn't play a role at all for you. But if they chose to do that, they could apply those rules themselves.
Absolutely. And yeah, it was encouraging to find that data from Morgan Stanley that showed that if you're longer your holding period, the less impactful multiples are on stock performance. But yeah, I mean, it is, especially as we're entering earnings season, these high valuation stocks can be a little scary, because even a high valuation stock, even if it on paper appears that it had good earnings results, if it doesn't hit that whisper number, or if guidance isn't what analysts are expecting, you could see some pretty significant near-term downside volatility.
And one more question before you get on to your next section. So let's say I'm a new subscriber, I'm getting started, and I've got a pool of cash to invest. How do I just buy everything? How do I go ahead and get started? Do I buy the whole portfolio? How would one go about and start investing?
At a minimum, I'd suggest at least 10 stocks and investing equal dollar amounts in each of those, not equal number of shares. With zero commissions on most online discount brokers these days, you don't have to worry about your expense ratio, and you're able to buy a relatively small number of stocks. But I would say a minimum of 10. If you're able to invest in all 20, even better. But again, if you're looking to, parse which ones you're to buy, if you don't want to buy all 20, then you might probably want to start with those that currently qualify. Avoid those that are on any type of probationary warnings or things like that. But definitely, whatever number you choose, definitely try to, as closely as possible, invest equal dollar amounts.
Thank you. I'll let you continue on, Wayne, and I'll be looking for more questions as we go forward. Thank you.
Thank you. So now we're going to touch on sort of our mid-year recap and review of the portfolio. The first 6 months of 2023 were good to the growth investing portfolio. It outperformed our benchmark, the iShares Core S&P 500 ETF, again, ticker IVV. The growth investing portfolio is up 24.7% through the first 6 months of 2023 versus a total return gain of 16.9% for our benchmark. So you see almost a 8%, my number's correct, 7%, yeah, almost 8%, 8 percentage points outperformance the portfolio versus our benchmark. And I touched on earlier is the stocks that are passing obviously are the ones that are doing the best are really latching on to the overall trend in the market at that time. in the portfolio's performance over the last 6 months definitely is buoyed by the strength in technology and consumer stocks. And this is indicative of the fact that the top 3 stocks in the portfolio year to date were HubSpot, which is up 84%, Amazon.com, which is up over 55%, and Chipotle Mexican Grill, which is up over 54%. And the weakest stock in the portfolio year to date through the end of June was SiriusXM Holdings, and that was down almost 22%. And this is showing what was driving the market over the first 6 months of the year. Looking at the top and bottom S&P 500 sectors year to date, again, information technology, so those tech stocks up almost 43%, communication services up over 36%, consumer discretionary up over 33%, well as the laggards were energy and utilities, both down almost 6%. And then also, there's definitely over, as I talked about, growth versus value, and those are probably the two most well-known investment factors. But various factors will outperform or underperform over a period of time, and they will fall into and out of favor. And over the first 6 months of the year, high beta stocks were the best performing factor, up over 23%. Growth up 21.3%. So again, this was definitely the first 6 months of the year was a very conducive to growth-oriented approaches. Quality, though, another element of the growth investing approach, was also a strong performer, up almost 16%. And then on the flip side, you see low volatility, high dividend, as well as high dividend as being the poorest performing factors over the first 6 months of 2023. And as I talked about previously too, the growth investing portfolio is a highly concentrated portfolio. We go where the data tells us to go, and we're not looking to diversify necessarily across sectors and industries, and that has led to a highly concentrated portfolio. Obviously, this benefits when these particular sectors are the ones that are in control. But earlier in the year, when tech and whatnot was lagging a little bit, it weighed on the portfolio. So you'll take your wins and your losses. Again, the key is to having that long-term approach and confidence in your overall strategy. But as the end of June, over the portfolio is nearly 56% invested in the technology sector, almost 19% in consumer cyclicals, almost 13% in healthcare, and then smaller concentrations in consumer non-cyclicals, industrials, and financials. In the end of June, we had a very, very small cash balance, which was counted for only 0.4% of the overall portfolio. And again, that's we were almost fully invested from our initial allocation to the portfolio right off the bat, and then monthly interest from our sweep account, as well as any dividends from the 4 or 5 stocks that do pay dividends in the portfolio. And then we have our since inception performance, and we started trading the portfolio on October 26th, 2022, and through the end of June, the portfolio was up 25.4%, versus a total return gain of 17.6% for the IVV ETF. Since inception, HubSpot is again the portfolio's top performer, but it's joined by Adobe and ASML Holding. So you're getting a little bit some of the secret sauce as far as giving some of the current holdings, and aware of that. So at the other end of the spectrum, we again see SiriusXM as the worst, one of the worst performers, as well as Star Surgical. Since inception, 10 of the growth stocks of the 20 that we currently hold have outperformed the benchmark since they were added to the portfolio. Any questions, John, regarding performance?
Uh, Certainly, a couple of questions as to why focus on the S&P 500? Why not consider either a mid-cap index or a growth index, and why do you even use an ETF as opposed to the S&P 500 as a whole itself?
So I'll tick these off individually. We use an ETF because as an investor, you can invest in an index. So an ETF is something that an investor can actually invest in. It's a return that an investor would actually generate by holding that. So that's why we use an ETF. That's why we use IVV for the growth investing portfolio. We use IYY for SSR, DI, and VMQ. So that's why we use an ETF as our benchmark.
And it gives you total return as well. So it gives you and it's a low cost index. It should mirror the underlying benchmark very, very closely, and you could track the performance on a real-time basis.
And I can actually make a mental note. I can include this commentary in our show notes for tomorrow as well, because I did an article on why I chose the S&P 500 as our benchmark. The stocks that historically will pass this particular strategy are large cap stocks. So I felt that using the S&P 500 was a better approximation of the universe of stocks that this approach would be invested in. Certainly, very few stocks in this portfolio are mid cap. Certainly, almost none are small cap. And then when it came to a growth index, I could have gone either way there. But looking at the criteria that a lot of growth indexes use to identify growth stocks, it's not the same definition of growth that I follow for this approach. So I found that it was an apples to oranges growth comparison. So that's why I went with the S&P 500, and actually in doing so, actually set a higher hurdle for ourselves, because over the long term, the S&P 500 index has outperformed the S&P 500 growth index. So if I wanted to take the easier route from a performance benchmark standpoint, the growth index would have been the way to go. But I felt that the S&P 500 index was a better all-round index. But it also highlights the fact that there is no such thing as a perfect benchmark.
Fair enough. But I guess based on the comments I'm seeing here, if you would probably periodically do an article talking about all the various benchmarks or indices and how they all compare against one another, probably would get a lot of readership of that.
Absolutely, and always looking for ideas too. So feel free to reach out if you have any ideas to write about.
And I mean, the other challenge, I guess, that someone pointed out is that you've obviously done some paper testing and back testing, but right now the portfolio has only been around for 6 months, so it's difficult. I mean, it's done well, great 6 months, but it's difficult to make any kind of long-term assessments as to whether or not that there's no guarantee of continued performance at level. So I don't know if you have any comments on that.
Very small sample set. Yep, absolutely. I'm very pleased with where I'm at, but I'm aware that yes, it's a very small sample set, and also, again, because I do have confidence in the long-term prospects of the portfolio, but I would not be the least bit surprised if this portfolio could go through prolonged periods of underperformance, especially if growth goes through where it falls out of favor for an extended period of time. So I'm fully prepared for that potential as well.
And so do you stay fully invested? And I guess another question along that line, is this an actual portfolio? So the performance you're quoting, is it hypothetical, or is it based upon a real portfolio?
It is a real money portfolio that was purchased over the course of probably about 6 weeks, starting October 26th of 2022. Roughly equal dollar amounts invested in all 20 stocks. We are fully invested over all periods of time. We have no type of market timing indicator that tells us whether we need to take money off the table or anything like that. So it is real money. So the performance that we report takes into account, transactions costs, bid-ask spreads when we were making the purchases, dividends received, insurance payments on our small cash holdings, etc.
And do you have any sense for what the yield of the portfolio is?
I would be shocked if it's above 0.5%. I don't have that number in front of me, but yeah, it is, again, dividends, definitely an incidental income for this portfolio.
I'll definitely keep watching the questions. I know you've got some more slides to go and we're getting late in time, so I'll let you continue on. Thank you.
Thank you, John. So, looking ahead, as Jenna pointed out to start, AAII nor myself are a registered investment advisor. So these thoughts are purely my own and don't necessarily even reflect those of AAII as an organization or other analysts here at the association. But the data continues to give mixed signals as far as what's going to play out for the rest of this year. This morning's inflation data was encouraging and provided a boost to stocks. I saw that the market was weakening a little bit, but as of this morning, actually, the growth investing portfolio had reached a new all-time high since its inception. But this tamer inflation data, and then hopefully the corresponding slowing of rate in hikes by the Federal Reserve, that's often a positive sign for growth stocks. Obviously corporate earnings play a key role in the stock market, and we're going to start getting a read on that as companies start reporting their second quarter results. Obviously a weaker than anticipated earnings season could have a significant negative impact on the stock market. And then, especially when you're looking at high valuation growth stocks such as those in the portfolio, lackluster results or weaker than anticipated guidance from management could lead to some strong short-term negative price volatility as well. And just the overall outlook for growth investing, again, we're still very much in the infancy stage of the portfolio, being around basically for 7 months. But even though there are trends toward growth or value stocks, it's nearly impossible to find the right timing to shift from one investment style to the other. Again, I said earlier, that's not anything that I try to do, either for this portfolio or for my investing, just personal investing. Therefore, the best way to leverage changing market trends regarding value and growth might be simply to choose the investment style that fits the needs, your own needs, and make your needs that are best for the core of your portfolio, and then allocate to other styles as a satellite portion of your portfolio. And with that, with a few minutes to spare, I want to thank everyone for attending today. And if there's any remaining questions, fire away.
Well, what do you do when you sell a stock? I mean, how do you rebalance? Do you rebalance if something's overweighted, underweighted? What do you do with the proceeds?
Excellent question. So we sell a stock. It satisfies one of the sell criteria that I've outlined, and remove it from the portfolio. At which point then I look at the average position size of the stocks that are in the portfolio. Ideally, we've sold a winner, and so I would never invest more than 10% above the average position size in the portfolio. That could then mean if we sell a big winner, that we would hold cash in a larger than normal cash position. Also then if we sell a loser and we haven't generated enough dividend income to boost our cash position, there is the potential for us to invest in an underweighted portfolio. We also have rules in place that this is more for an internal management, but if a stock's position grows to more than 2.5 times the average position size, I would then sell off a portion of that portfolio to bring it back to either roughly 100 to 110% of the average position size, and then we could hold that in cash to fund either an additional future purchases or whatnot. But when you sell a stock, always try to keep that average position size in place, as well as, probably on an annual basis. Again, we're only 6 months in, but on an annual basis, probably look at the position sizes, and if any position has grown again to 2.5 times or more the average position size, then try to scale that back to more in line with the average.
And you do that for a diversification basis? Why would you do that?
It's basically, yes, it would absolutely be for diversification benefits, so that one stock is not becoming an overweighted driver of the portfolio.
Now, if you're limiting the portfolio to 20 stocks, are those the 20 best that meet the model, or how did you come up with these 20, and why did you pick 20? Someone was asking.
That's subjective. I think if you look at all of our model portfolios, I think we range from 20 to 40 stocks currently, and personally, I think 20 is a good sweet spot as far as a number that if someone wants to buy the entire portfolio, it is not, I think, overwhelming when you're trying to manage it. But that is very much a subjective decision. There was no backtesting or analysis to decide what that optimal number is.
So you're trying to get some level of diversification, enough stocks so that in the philosophy or the approach should give you the types of companies that match that particular quality, but it mainly was just to give some diversification from that.
That is correct. Yes.
Okay.
Excellent answer.
Let's see here. Did you ever look at with your back testing? How did it hold up in various down markets? Were you able to see how it performed in that particular environment?
Yes, it actually it held up reasonably well. The overarching concept here is we're looking for the characteristics of these particular stocks are what you could consider secular growth stocks. And secular growth is growth that isn't as tied to the economic and business cycle. These are companies that have products or services that are in such demand that the overall economic or business cycle aren't going to have a significant impact on demand as a typical cyclical stock that we'll see. It'll do really well when the economy is doing well, and do very poorly when the economy is not doing well.
Since really it's you mentioned that brokerage costs are so low, and you do sell off a big holding position, why not just simply reinvest some of that excess proceeds in the existing other stocks in the portfolio to kind of bring the weight up?
You certainly could. That is, we do that for example, I think we do that for dividend investing as well as BMQ stocks, where if we have an outsized, an above average cash holdings, we'll invest in stocks that pass the initial selection criteria but that are underweighted. That's the problem there is in my mind, and that's why I chose to do it for this portfolio, was that circumstance doesn't always apply to subscribers as a whole. So you might be making portfolio decisions, portfolio announcements that don't reflect that of other subscribers. Whereas, if a subscriber owns HubSpot, their growth grade is the same for everyone, the growth score is the same for everyone, etc.
William here was surprised to see Cirrus XM as a growth stock. How does it fit the growth stock criteria?
It has sufficient long-term sales growth. It has a history of year-over-year sales increases and has a history of positive cash from operations. It also satisfied at least 7 of the 8 G-score criteria that historically research has shown points to quality growth companies.
So basically what
So
you're saying is that you're looking at a sustainable growth, not just simply, and that's what you're talking about, how potentially some indices, all they simply look for is the opposite of value for defining growth. They simply they put the value bucket in as being priced relative to some asset like price to book or whatever, and growth is the opposite end of that. So, but you're concerned more is companies that have a record of growth, and then you put even I think you talked about how important it was to have cash flow growth and consistency of growth. And so the function is not so much simply high levels of growth or being expensive, but A, does this company have a record? And B, is it doing the things today? Is it spending money on R&D and advertising that should help that growth continue in the future, right? So that's kind of your definition. It's more of a sustainable growth than just a raw high growth number, the quickest growth in the world. Although a lot of the companies that qualify, like, do have high growth, but it's just kind of you want that sustainability is probably the true function. I know Wayne and I debated the whether or not we should have called this portfolio the sustainable growth portfolio. So I think that's why
yes.
I keep wanting to needle him a little bit on those issues sometimes. So sorry, Wayne.
No, that's okay.
That's why we're remote today. So yeah, I can't actually needle you in person here. How quickly will a subscriber know that you've actually sold a stock?
Well, additions and I take that back. Deletions aren't made until after they've been announced to subscribers, nor will additions be made until after those announcements are made.
So you make the announcement first, you issue an alert of some sort, and then you, in your model portfolio, you'll then buy it afterwards.
That is correct. Yes, we're not quote unquote front running.
And then someone makes note of they hate Sirius's customer service, so that just as I guess they might be investing in R&D and advertising, but I guess they could use a little bit of help with their customer service.
Luckily, I haven't had to deal with them, I'm sure, but it serves me well on my trips to and from Michigan in my Subaru Outback.
Excellent. So have you done any work as far as using stop losses to help with your exit points, or do you have any sense on whether or not trend analysis is something that a subscriber could use in addition to this or on top of this?
I mean, obviously, as John's alluded to, you can overlay your own. I mean, if you have a trend following strategy that you like to follow, you certainly can overlay at that. I try to avoid, we only have one performance sell criteria, and that's the 3-year underperformance. Trying to have a long-term investment approach. Any type of trend following is probably going to, obviously it can protect you to the downside, but then oftentimes it can stop you out and shave things off to the upside too. So I'm more concerned with staying with a stock as long as its fundamentals are there. The 3-year is basically after 3 years, there's an opportunity cost. If it's underperforming, I think that is a sufficient amount of time to cut loose. That's David Dremen uses a 3-year strategy looking at performance relative to the market. So those aren't elements that I use. Try to following pretty much a purely fundamental approach. But again, it's the nice thing about this is, if you have other frameworks that have worked for you, that you might be able to apply on top of this framework.
Thank you. Let's see here. We're kind of running low on time. You had a slide on looking ahead regarding recession probabilities. Are you slide 34? They're wondering, how do you feel? I mean, I know you've got some probabilities there from other sources. Do you have any sense on what impact they are and how they impact a subscriber?
Actually, I'm glad that was brought back because I feel I'm mad at myself for skipping over this. But the second half of this slide shows you, you've got probabilities anywhere from 0.62% to 99% that we're going to go into a recession. So, it's the common adage, you have 12 economists in a room and you ask them what their outlook on the economy is going to be, and you're going to get 13 different answers. Obviously the inflation number was promising. Whether or not that holds true and the Fed is able to curtail It's interest, raising short-term interest rates. Obviously, you know, the more they raise interest rates, probably the higher the probability of there being a recession. But it seems like, you know, if inflation is cooling and the Fed doesn't have to do much more tightening, that we might be able to avoid at least a full-blown recession, or at least have that that quote-unquote soft landing. But you know, I was an econ minor in college, and that was you know, so I appreciate the dismal science and how difficult that number can be. But I think by and large, I think I feel fairly confident that we'll avoid a recession, or at least be able to hit that soft landing. But we should, you know, probably know very quickly over the next few weeks, as earnings season really starts to ramp up, and you know, as companies start reporting corporate earnings, and we get an indication of what this impact might have had on corporations.
Interesting. Well, thank you. And I guess we'll perhaps close off. We've got a lot of members here are giving you their kudos as to the quality of the presentation. But the last series of questions I'm going to ask for you have to deal with ideas. So members are really asking, you know, how can they use the ideas list? Do they use it? And if they, let's say they have extra money to invest, do they just, how does one use the ideas list as a subscriber?
So the ideas list ultimately supplements the current portfolio. You know, the ideas list, as I believe I said, in order to be on the ideas list, the company has to satisfy all the initial selection criteria for the growth investing approach. And this would be the pool of stocks that I draw from if and when I delete a stock from the portfolio. But just because the stock is on the ideas list doesn't necessarily mean that it will ever end up in the growth portfolio, the real money portfolio. So if you were to add anything from the ideas list, or purchase anything from the ideas list, it would be up to you to have to monitor all the different sell criteria that you would have access to as a growth investing subscriber. But it would be up to you to determine when it was time to delete a stock from the portfolio, whereas I'm doing that for the stocks that are in the actual portfolio. So it's a great way to supplement. So, I mean, if you only want to buy those stocks that currently qualify, which is 15, but you want to add more, then the ideas list, these are stocks that satisfy all of those. Again, I would, you know, tiebreakers, you know, sort by G-score, then by growth score, and then by quality score. Those would be my tiebreakers. So definitely, they're a great way to supplement the stocks that are in the real world, the real money portfolio.
Well, thanks very much, Wayne. Very, very informative webinar. And I tried to stump you. I couldn't stump you, but we'll have to give it another try.
You're going easy on me, John.
One request that let me give you something to think about. A member was asking here, how does growth investing, this could be probably a subject of a future webinar, how does the growth investing model portfolio compare to the other model portfolios? And how would one of our members pick one approach versus another? What would they expect? So something for you to think about, and maybe a tease for a future webinar. I know we did one on that in the past. So with that, great webinar, Wayne. And I see Jenna's back to help take us out of the show.
Thank you, John, and thank you, Jenna, and thank you, everyone. Go ahead, Jenna.
Thanks. Yeah, no, that was a great presentation. I just wanted to highlight, as you can see on the screen, we do have a exclusive sale price for everybody who attended today. So usually growth investing is priced at $248, and for members who or for attendees today, we have the $97 price point. And then we also have options for 3-year, and as well as Platinum Life and Platinum options on the URL. So you just go to invest.aai.com/growth-investing-97-members. And if you download the PDF, you can actually click on that link. It'll be a live link. And then I also put it in the chat. I tried to, as Wayne was presenting, I tried to include as many resources that I thought were helpful along the way. So there was, so if you go into the chat right now, you can see that there are links to resources, all kinds of articles that Wayne mentioned, as well as how-to resources that go back to the growth website. And all of those links and resources will also be included when we send out the handout tomorrow afternoon. And I do want to thank Wayne for highlighting key insights about the AAII Growth Investing strategy and portfolio. And also I want to thank John for facilitating such a robust Q&A session. And if you have questions for Wayne regarding his presentation, or if you have questions about the growth portfolio or any of the content, feel free to message him at wayne@aaii.com. We also threw that in the chat earlier today. And for questions about accounts, membership, any kind of issues you're encountering, please email members@aaii.com. And if you like today's presentation, you can always visit aaii.com/webinars to see all of our archive presentations, as well as see what's next. And to mention again, this presentation is recorded and a replay of the webinar will be available tomorrow on AAII's YouTube channel, as well as our website. And we will include all of the links mentioned in this presentation, as well as the official handout. And with that, we wish all of you viewing good health, good fortune, and a great rest of your day. Thank you and take care.